Hello everyone, welcome to the market opening bell on Thursday, August 14th, your 10-minute guide to the stock market. With markets anticipating a US Federal Reserve rate cut next month, Hong Kong stocks surged significantly. The Hang Seng Index opened 206 points higher and extended gains, closing at the day's high of 25,613 points, up 643 points or 2.6%, marking three consecutive days of gains. The Hang Seng China Enterprises Index rose 233 points or 2.6% to 9,150 points, while the Hang Seng Tech Index climbed 191 points or 3.5% to 5,630 points. Total market turnover surged nearly 32% from the previous day to 284 billion Hong Kong dollars. Southbound trading turnover reached 153.7 billion Hong Kong dollars, while southbound funds saw a net outflow of 8.277 billion dollars compared to a net inflow of 9.45 billion dollars the previous day, marking the first net outflow since August 4th, when the net outflow was 18.092 billion dollars. Net buying included Innovent Biologics at 709 million, Li Auto at 366 million, Hon Hai Precision at 234 million, and Xiaomi at 175 million. Net selling included Tracker Fund at 6.85 billion, Hang Seng China Enterprises ETF at 2.311 billion, Tencent at 250 million, Alibaba at 243 million, and Meituan at 188 million. Southbound funds have recorded net buying in Xiaomi for 5 consecutive days, totaling $3.317 billion. Technically, the Hang Seng Index reclaimed the 25,000 point level and the 20-day moving average, signaling the end of short-term consolidation. The index may target the July 31st high of 25,736 points, with the next goal at 26,200 points. In the Asia market, stocks opened higher and maintained upward momentum, with the Shanghai Composite Index hitting a four-year high, rising 18 points or 0.5% to 3,683 points. The Shenzhen Component Index gained 200 points or 1.8% to 11,551 points, while the Chinex Index surged 87 points or 3.6% to 2,496 points. Total turnover for Shanghai and Shenzhen markets reached 2.15 trillion yuan, up 269.5 billion yuan from the previous day. The renminbi central parity rate ended a three-day decline, rising 68 pips to 7.135 against the US dollar. The People's Bank of China reported that RMB loans increased by 12.87 trillion yuan in the first 7 months, below market expectations of 13.22 trillion yuan. July saw a negative loan growth of 500 billion yuan, the first since July 2005, against expectations of 300 billion yuan growth. Social financing scale for the first 7 months reached 23.99 trillion yuan, up 5.12 trillion yuan year on year, but below expectations of 24.46 trillion yuan. By July's end, broad money supply M2 grew 8.8% year on year, exceeding expectations of 8.3%, while narrow money supply M1 grew 5.6%. In corporate earnings, Tencent Holdings reported second quarter revenue of 184.5 billion yuan, up 14.5% year on year, surpassing expectations of 179 billion yuan. Value-added services revenue reached 91.368 billion yuan, up 15.9%, with international gaming revenue at approximately 18.8 billion yuan, up 35%, and domestic gaming revenue at approximately 40.4 billion yuan, up 17%. Social network revenue grew 6% to about 32.2 billion yuan, driven by mobile game virtual item sales, WeChat video live streaming, and music subscription revenue. Marketing services revenue rose 19.7% to 35.762 billion yuan, while fintech and enterprise services grew 10.1% to 55.536 billion yuan. Second quarter net profit was 55.628 billion yuan, up 16.8% with earnings per share at 6.115 yuan. Under non-IFRS, second quarter net profit grew 10% to 63.052 billion yuan. Gross margin improved from 53% to 57%, and value-added services margin rose from 57% to 60%, driven by domestic games like Delta Force. Tencent increased AI investments, boosting revenue and non-IFRS operating profit by double-digit percentages year-on-year. Games like Honor of Kings and Peacekeeper Elite enhanced AI applications. By June's end, Tencent repurchased 81.87 million shares for approximately 36.5 billion Hong Kong dollars, with a 2024 repurchase plan of at least 80 billion Hong Kong dollars. Net cash was 74.6 billion yuan, down from 90.229 billion yuan, mainly due to a 37.5 billion yuan final dividend payment at 2024 financial year for 2024 financial year. Hong Kong Infrastructure reported first half revenue of 20.359 billion Hong Kong dollars, up 6.6%, with net profit growing 0.9% to 4.348 billion Hong Kong dollars and earnings per share at 1.73 dollars. The interim dividend was 73 cents, up from 72 cents last year. Power Assets reported first half revenue of 352 million Hong Kong dollars, down 22.5%, with net profit rising 1.2% to 3.042 billion dollars and earnings per share at 1.43 dollars. The interim dividend remained at 78 cents. The UK, the largest market, contributed 1.724 billion Hong Kong dollars in profit, up 11%, while Australia contributed 652 million dollars, down 4.3% due to Australian dollar depreciation and reduced profit from energy developments amid contract expirations and lower market electricity prices. Samsonite reported first half net sales of 1.662 billion US dollars, down 6% due to macroeconomic uncertainties, trade policy changes, cautious wholesale procurement, and weaker consumer sentiment. Net profit dropped 30.2% to 118 million US dollars, with earnings per share at 0.085 US dollars, and no dividend was declared. Gross profit was 984 million US dollars, down 7.6%, with gross margin narrowing from 60.2% to 59.2%, driven by a lower share of high margin Asia sales and strategic promotions to boost sales volume. Company announcing earnings today include CK Hutchison, CK Asset, JD.com, NetEase, China Telecom, Geely Auto, JD Health, JD Logistics, MTR, NetEase, Cloud Music, Hyzon, USU REIT, and SF REIT. JD.com projects second quarter total revenue of 333.4 to 339.5 billion yuan, up 14.4% to 16.5% from last year's 291.3 billion yuan, driven by China's trade-in programs and shopping festivals. However, aggressive expansion into food delivery and heavy subsidies may lead to a non-GAAP net profit of 4.32 to 6.081 billion yuan, down 58 to 70.1% from last year's 14.46 billion yuan. Amid China's anti-involution trend, JD.com has pledged to resist predatory subsidies like zero-yuan purchases. Investors will focus on JD's latest strategies for food delivery, instant retail, overseas expansion subsidies, rider welfare, and potential synergies from delivery operations. NetEase driven by strong PC gaming revenue, including Marvel Rivals and Yuan 16 Sounds, and the return of Blizzard games offsetting challenges in mobile gaming transformation with fewer new mobile games expected. Projects second quarter net revenue of 27.6 billion to 28.992 billion yuan, up 8.3 to 13.5% from 25.486 billion yuan last year. Net profit is expected at 8.317 billion to 8.977 billion yuan, up 23.1 to 31.3% from 6.759 billion yuan, with non-GAAP net profit at 9.115 to 10.002 billion yuan, up 16.6 to 27.9% from 7.819 billion yuan. Investors will focus on NetEase operational strategies, new game performance, user retention, AI-driven features like Han, AI gameplay, and Naraka, Bladepoint AI teammates, and their impact on interactivity and monetization. The Hong Kong Stock Exchange revised IPO pricing and public offering rules earlier this month, optimizing the share reallocation mechanism. The first IPO under the new rules, InnoCare Pharma, closed its subscription on August 12, reportedly oversubscribed by approximately 5,364 times, with around 260,000 applicants and approximately 370 billion Hong Kong dollars in funds, making it the second most oversubscribed IPO this year, behind Blocks at nearly 6,000 times. Watch for today's grey market trading. Driven by Fed rate cut expectations, U.S. stocks opened higher. The Dow Jones Industrial Average rose 463 points or 1% to 44,922 points, up nearly 1,000 points over 2 days. The S&P 500 gained 20 points or 0.3% to 6,466 points, and the Nasdaq rose 31 points or 0.1% to 21,713 points, both hitting record closing highs. Tech stocks show mixed performance. AMD rose 5.4%. Amazon and Apple gained over 1%, while Nvidia fell 0.9%. Tesla dropped 0.5%, and Meta declined 1.3%. Crypto exchange Bullish debuted, soaring 2 times to $118 before closing at $68, approximately 84% above its IPO price. Tonight, the U.S. July PPI is expected to rise 0.2% month-on-month, flat previously, and 2.5% year-on-year, up from 2.3%. Core PPI is projected to rise 0.2% month-on-month, flat previously, and 3% year-on-year, up from 2.6%. Former President Trump stated that potential candidates for the next Fed chair have been narrowed to 3 or 4, describing them as excellent and outstanding. Our stock pick today is Techtronic Industries, stock code 669. Techtronic Industries delivered a robust performance in the first half of 2025, achieving a record-breaking sales revenue of $7.8 billion, up 7.5% in local currency terms and 7.1% in reporting currency terms. During the period, the Milwaukee business grew by 11.9%, while Ryobi saw an 8.7% increase. Non-core business sales strategically declined compared to the first half of 2024 as the group focused on executing its business plan to streamline its product portfolio and enhance profitability in these areas. By region, North America recorded an 8.1% sales growth. Europe saw a strong 10.4% increase, while other regions experienced a 3.4% decline. In the first half of 2025, the gross margin improved by 34 basis points to 40.3%, primarily driven by the group's focus on enhancing consumer brand profitability, improving operational efficiency, the positive impact of the high-margin Milwaukee business growth and increased productivity across its production and procurement network. As a percentage of sales, total selling, general, and administrative expenses decreased by 18 basis points to 31.3% compared to the first half of 2024, reflecting the group's emphasis on optimizing and reducing non-strategic administrative expenses while investing in research and development, new product development, and commercialization. The group's first half net profit rose 14.2% to 628 million US dollars, with earnings per share increasing 14.1% to 34.37 US cents. It also reported a positive free cash flow of 468 million US dollars, ending the period in a net cash position, enabling continued investment and business expansion while navigating macroeconomic changes. Looking ahead, the group will continue to pursue three key initiatives: growing existing businesses and verticals, exploring new businesses and verticals, and expanding global market coverage. Currently, the group's core verticals span multiple industries, including mechanical, electrical, plumbing, renovation, public utilities, transportation, maintenance, general contracting, landscaping, energy, and mining, each encompassing subsectors with unique applications and needs. Close collaboration with these users helps the group identify solutions to customer challenges and develop practical, innovative products. The group's growth extends beyond verticals to cross-border opportunities, with mining in regions like Australia and Latin America, which have global influence, aiding faster market expansion in these areas. Recommended buy price is 101 Hong Kong dollars, with a target price of $111 and a stop loss at $95.5. I do not hold the aforementioned stock.